Hi, this is Randy Finney with the right side of the chart, and today is Monday, December 4th, 2017. I wanted to do an update on the markets. We'll look at mostly QQQ here today. I'll talk on the sector rotation, some things that have been going on, touch on energy as well. That's a sector worth mentioning now, and that's one where we've seen sector rotation move into. We've seen a lot of money going into financials. Mainly, they've been one of the biggest beneficiaries in the last few weeks with all the buzz on the tax law changes. And then we've seen energy rebounding as well. So I'll talk on that. I'll touch on the biotechs, a lot of the things that I've been covering in recent months here. And gold and GDX, I'll tell you right now, there's just not a lot. I get a lot of interest, probably more interest over the years on gold and the gold mining stocks and any other sector, asset class, anything out there. Um, and as you guys know, I've been, pretty clear lately. I've just sidestepped that trade. I'm just staying away because it's been a sideways grind. And until we break out of that sideways range, um, there's just not a lot to report on the technicals. Anytime you have anything trade sideways, the indicators flatten out. That gives you very little cues to the next near-term direction. Longer-term charts still tell me I'm still bullish on gold, and I think the next major trend will most likely be to the upside, but we just don't have any reason to be long or short right now. So, all right, back to the markets. Before I get into that, right before the video started, shortly before I started recording this, I had a trend alert on BABA, BABA, that's Alibaba, and you can see here we're pretty far below that trend line now. I got the alert right when it triggered. I put up a chart in the trading room the other day in some comments. Somebody inquired about this one, so I just wanted to share that as I'm doing this video. If it takes me a while to wrap the video up and get this out, this may be an official trade idea. A little gap right here, about 162.56. And then down to about, I'd say that first target, if this breakdown sticks, will be there about 160.55. Look for a reaction there. And next target be about 148.50. And then finally, ultimately, a backfill of this gap right here, or at least a test of the top of the gap. Doesn't have to backfill it. That's where I'd cover if you're a long term, put on a short trade and you're willing to ride out those counter trend bounces. I think this one comes back down to about 133 in time. Nice negative divergences, just like you had a divergent high here. You can see the correction there. You see the divergent low. That was a good time to go long. You can even actually had a wedge drawn here before. That's actually a breakout of a bullish falling wedge. So there's Alibaba. Looks pretty good. Sometimes you get these intraday breakdowns. We had one here. You can see that candlestick tail right there, the wick. They refer to that as a wick, or I'm sorry, a shadow or a tail when it's below. A wick is on the upside. And that means that it broke down intraday. We already had a trend line formed at that point. You can see a couple reactions, but we snapped back up. Now, given that was early in the rally, number one, and we didn't have any negative divergence, so there wouldn't have been any reason to really take a short there, especially intraday on an intraday break. So now we're pretty impulsively down through there, about a little over 2.5% or 2.2% drop. Um, so watch it, and if you want to take it now, just if it snaps back into the trend line, especially today, that's where you'd probably want to stop out. This should have no business snapping back above trend right now. So there's a potential short trade for you. Okay, so I had to pause the video for a while. Decided to take that one and also post as an official trade idea. So here's the targets right at the time I just fired the post off. It bounced a little bit from where I took the screenshot. So by the time you get that, hopefully you'll have a more favorable entry. So look for a back test. That's the next objective entry. I put the stop right about up here, roughly a 3-to-1 RR to the final target, which is usually what I do. Those are the suggested stop is usually or always the maximum suggested stop if you're targeting the final target. Now, if you're going to go for one of these earlier targets, obviously you don't want to have an a loss potential that's equal to or greater than your gain potential. Then it's a 1-to-1 risk reward ratio, and that's not very favorable. I usually shoot for at least a 3-to-1 RR or better. So I think from to the final target, you're talking about a 21% drop. Therefore, you can allow for about a 7% stop loss. Plus, you can see there's some price resistance up there as well. You have a couple reactions right here and here and here, and that stops placed just above that level. So Just a little sidebar on how I calculate and figure where the stop level should be. So it's a combination of looking at the risk to reward ratio, but then also looking at where resistance is, and then strategically placing a stop just above that resistance level. Because if we do kick back, ideally you want to see it now stay below trend, that trend line. If it gets back above there, it might be an intraday pop into it and then fall back below, and that's why there's a little room there if it decides to have a kickback rally. So there's BABA. All right, back to the markets. I can't remember. I don't think I started on QQQ yet, so we'll whip through this pretty quickly. Um, Last week, if you recall, even before we broke down from this rising wedge, I had this rising wedge pattern, another divergent high. You can see it all there on QQQ. We had a very impulsive breakdown. A lot of that, the impulsive nature of that move had to do with the news release on the Flynn, testimony. He'll be testifying against was it Kushner? So we'll see. And of course, that didn't come out till after who he'd be testifying on. There was all this talks on the media about potential, impeachment, what would happen if it's going to be Trump, et cetera, et cetera. So the market overreacted. But again, this stuff was priced into the charts. The breakdown was identified in advance, and that just accelerated the move. And when we came down, hit that level, we had a bounce, and even before then, I expected, once we started bouncing off, there was a target there. You can see it was a gap backfill. So the point I'm trying to make here, a couple points really, is that the technicals work very well, especially when the market has any surprise news and knee-jerk reactions. At that point, fundamentals are out the door. So traders, particularly the computer, algos, high-frequency trading, things like that, they look at, and traders themselves look at support and resistance levels, and that's where you're usually going to see the market bounce or sell off if it breaks down. So right here, you had a gap. You can see that. You had a gap back here, but you had another gap there, and that's why I had these two lines, and that's where we found support the first time around. When we had that bounce, my expectation was for an undercut, a brief undercut of those lows, and that's exactly what happened on Friday. You can see we undercut with a very long, look at how long that candlestick tail is, the shadow of the candle right there. That means we shot down, undercut those lows, and immediately reversed. And one of the things I was looking for, and the reason I was expecting one more undercut of these lows, is when you see an impulsive move like that, very rarely is that the end of it after that. Usually corrections occur in at least an ABC wave, this being the first wave down, A, B up, and then a C down. So if it's just a simple corrective phase, that's it now. This may be more. There may be more to this downside, this drop. And I do think I still favor over time these targets down here. I'll outline that in a second. But either way, so we got the undercut of the lows, and I was also noting that these indicators had come down and peaked here, and usually any meaningful bounce or reversal come on with divergence in place, and that's what it did. Since we made a lower low in price right here with higher lows, we got that divergence. At least it shows just a little bit here. We really had to zoom in to see it on the 60-minute chart. Shows a little better on the 15 and 30-minute time frames, but either way, so we bounced from there, and it was a pretty good bounce. One of the things I wanted to mention too in this video is we're finally, for the first time in a while, seeing some nice volatility. When I say nice volatility, traders need volatility to make money, especially active traders. So if you're trading things like index funds, whether it's QQQ or SQQQ, TQQQ, the leveraged ETFs, or NQ E-minis, for the first time in a while, you can make some really nice gains, either day trading or short-term swing trades lasting just a few days, maybe a session or two, and so that's what we're looking at. And right now, I'm standing aside here. Let's let the dust settle. What's happened so far is we bounced up. We failed right at that previous reaction high there, and we're moving down today. So in other words, the Q's gapped up today, and they faded that gap so far. So levels to watch. Let's see again how the dust settles with this whole tax bill. The House and Senate have to reconcile their versions of the bill, and that's expected to happen. So now the big question is most, if not all, of the potential for these tax cuts, have they been priced into the market or not? That's the $1 million question. The market is up tremendously since Trump was voted in, over a year ago now, and so how much of his agenda and such as these tax cuts are priced into the markets and how much aren't. We'll see. So right now, there's just not a clear reason to be long or short. But if you want to know where I think things are going, and if you're swing trading, of course, you can be. I'm talking intraday stuff. But right now, I continue to expect a move down to that 150, 120 area. Reaction there might take us up back here and then a move down to 149.20. That's my preferred scenario, but you got to watch it here because we already had a pretty decent correction. In fact, if you look at the wedge here, you measure the widest point of the wedge, add that to where prices broke down from the wedge, and that roughly gives you about what we fell so far. So the wedge pattern has met its measured target. And but then again, I can go out to the daily chart and make a case for more downside. Again, you have to pay attention to what time frame you're looking at. So right now, let's just watch these highs here. We had a reaction high there. We tried to take it out today. We took it out by just a hair, but then reversed. So if the Qs break above this level, those two reaction highs, and again, keep in mind I'm on the 60-minute charts, well, the next test is these previous highs, and then you have all-time highs if you take that out. So that's what we're looking on the Qs. Keep in mind, this has been the leading index for pretty much throughout the entire bull market and up until just recently. And we've seen a changing of the guards. Now, that so far, I have to say, has taken the form of healthy sector rotation. We're seeing the financials just catch a tremendous bid lately. Energy's been doing well. So the fact that the generals are finally rolling over. I'm talking the FANG stocks, Facebook, Amazon, Alphabet, Microsoft, um, which ones did I not cover? And I think I hit them all. And Intel, I also use a term FAAMGI, FAAMGI. Intel's, number 6 up there. And those are all now, if you look at the 60-minute charts, we'll just go through those real quick. They're all off their highs. This is, again, 60-minute chart. There's Apple. Here's Alphabet, GOOGL, and then the other share class, GOOG. And you can see they're also at very interesting levels. I should back up a minute. They had divergent highs right here, as did the Qs, of course. These 5 have divergent highs, and the Qs are going to have divergent highs because these 5 stocks pretty much are QQQ. So there it is. And this is still making right now, as of now, call it what you will. Maybe it goes, maybe this ends, but as of now, we're in a confirmed downtrend. A downtrend is defined by stocks making a series of lower highs and lower lows. And so what would bring that downtrend into question? Well, a break above this previous reaction high. What would keep it going and affirm that we're in a confirmed downtrend is a break of these recent lows there. That's it. Let's not overcomplicate it. Let's see what happens. Trend indicators are bearish right now. Here's Alphabet, divergent high as well. Again, 60-minute chart. And we have divergences out on the daily. I've been talking about those forever. The problem is they can continue to diverge. Those divergences have built. They could be negated eventually, mean taken out. But most importantly, they can take a long time to play out, even if they do play out. So let's just focus on these 60-minute charts because I think this is the most effective way to try to navigate these markets, especially for swing traders right now. And there it is. We've now backfilled. See this gap right here? We had a big gap. This is the gap from this point to this point, but we had a reaction high there. So what I do is if I see a gap, even though technically, this is where we closed the previous day, that's the bottom of the gap. I look at reactions there, and that's where we're at right now, that 116.19-ish level. So we're at support, but following a pretty powerful divergent high on the 60-minute chart. As you can see, trend indicators are bearish. Obviously, you're going to see almost an identical chart on GOOG, a little more downside left to hit those reactions. Microsoft, no divergent high on Microsoft, but you had a trend line here that was broken and back tested several times. And probably the most important point on this chart right here is this support level. We had a little dip below it when the trend line broke and we back tested, but look how many reactions right there. And then most importantly, look what's down below. A big fat gap. Gaps are like vacuums. And if we enter that gap, so at this point to be safe, since we had reactions, you want to set a support line just below those recent lows. If we enter that gap, chances are odds favor that it will be backfilled. And what does that mean for Microsoft, one of the world's largest stocks and leading components of QQQ? It means about a 4.25% drop. Very doubtful QQQ and or the market will rise if Microsoft falls 4.25%, because these stocks, these FAANG stocks, are so tightly wound together. They're, whether you're trading QQQ, you sell QQQ, you're selling all of these stocks, and the institutions are loaded up with them. So for the most part, these stocks tend to track each other very well. Every now and then there's a disconnect, but again, the charts right now are in alignment. And the common theme here is as I go through all of these, we see these divergent highs on the 60-minute chart. Here's Amazon. You can see a little trend line there, just now breaking down. I'd be surprised if Amazon doesn't come back down once more and test that 111 11 20 60 level. And if it does and it's a successful test, then yeah, maybe we go on to make new highs. But if not, that is a support level. Hard to argue it's a significant support level because you can see a lot of reactions there. So if you're looking for, watching Amazon and you're watching Alphabet and Apple and Facebook, and you see them all one by one break these support levels I'm going out on the 60-minute chart, that means we're going to have more downside. However, if you see them all successfully defend those support levels, those gaps and other lines that I'm talking, then maybe we'd have another thrust higher. So that's why I'm sort of standing back right now, let the dust settle from those big swings we had last week. That was about the most volatility we had in a long time. There's Facebook, same common theme. See the divergent high on the 60-minute chart, and you can see the indicators there. Trend indicators are still bearish. And again, this all goes back out. You go out to the daily charts on all of these as well, and this is what I mentioned. We have these divergent highs. We had a divergent high here, didn't play out for much, but that didn't mean that it doesn't count or the divergences didn't work. It just means they're being extended. And unless the PPO and the RSI down here, unless they take out these previous reaction highs, you still have divergence. You may have negative divergence all the way out here. You could do something along those lines, like go down and then up, and then put in a divergent high within this wedge. So in other words, you extend this wedge pattern here, extend the lower trend line. There's a rising wedge, but the big sell signal will come on a breakdown below these daily uptrend lines on not just Facebook. They're all there. Apple, Alphabet. There's Google. There's Apple. Haven't drawn it here. You could probably throw a trend line in there as well. And that's what you want to look at for bigger picture. And so you can see the nature of all these are wedging up, just like we had that 60-minute wedge. And sometimes you have a smaller wedge, you have a breakdown, and we did have that as well. We had a wedge breakdown a few weeks back on the 60-minute chart of QQQ, and it played out for a little correction. And we pushed up, and we're just pushing up now within this bigger wedge. So what's the takeaway from this? Well, when your prices are compressing within a wedge, it tends to be noise. And a lot of volatility, but the nature of a wedge, it's price compression. It's an uptrend that's losing its vigor, its strength. So the thrusts up are getting weaker and weaker, and that's what gives you the negative divergence. These are momentum indicators, the PPO and the MACD, and they're showing you that the momentum is waning. Now, can these patterns be busted up? Sure. But if not, respect it for what it is, and it's just showing you that all these market leading stocks are, even though they've been underperforming recently, which in itself is a red flag. Again, right now, not a whole go all in short because the leaders have rolled over or are rolling over, showing relative weakness. That'd probably be the best way to say it. They've not really fallen much. They're just not participating in the rally. The rest of the market, a lot of other sectors are moving higher. However, should they break down, I can all but assure you, if you see these guys break their daily, uptrend lines, in these leaders that have most of the money, a lot of institutions, individual investors are in these. If they break down, that selling will almost certainly spill over into other sectors. Severely doubt we'll see QQQ drop 5 or 10% and SPY, IWM, and those continue to rise. Very, very unlikely. All right, so let's wrap it up here on the index charts. I covered Microsoft, I covered Amazon, Facebook, I showed you, and then Intel. There's Intel, and this segues into the next one. Intel, again, is like, I believe, the sixth largest holding, and you can see the divergent high there, negative divergence, move down, and a pretty well-defined uptrend line. Look at all these reactions, breakdown, backtest. And so I guess the common theme is we're sitting on some pretty key technical levels. I should add a line right here. There's that top of that gap right there, and there's the bottom of the gap. And if that gap is entered from above, if this trend line break plays out after this back test, maybe one more back test, we come back down there, test the top of the gap, but then look for a potential backfill of the gap. And if these 60-minute charts start to play out, then you zoom out to the more important, more significant daily time frames, and you watch these trend lines here. And that, I guess that's the same gaps, really, this chart. And daily chart, you can see the same gap I was looking at on the 60-minute chart. But if that gap gets backfilled and then we move below it, then we're probably coming back here to test what used to be a double top high, and then we finally broke out on Intel. All right, that leads me to the next thing. Tech has led this market for a long, long time. Again, glass half full. We say, okay, well, tech's taking a breather. It's done very well, and now we're seeing a shift into leadership, into financials and other things. Maybe, maybe not. I maintained for a long time when the FAANG stocks died, when they were finally taken out and shot, and they haven't been shot yet, but everything's setting up. They're certainly displaying, as I said, relative weakness recently, and the king of tech, or I should say the canary in the coal mine, is semiconductor sectors. Semiconductors are usually the first to go when the tech sector goes. If the semis are having problems, the rest of the sector will eventually spill over there. That's at least been my experience over the years. Nothing's 100% in trading, but watch these stocks. Now, this is also priced in the chart. This just may be a healthy correction in a long going, bull market. Maybe, maybe not. You never know which one of these divergent tops can play out for a lot more. What we do know is there's a tremendous amount of hot air. There's a lot of momentum traders in this sector. And I've been highlighting this one recently, even did a video on it. It's that important, I think. So there's an extreme overbought reading. That's what that means there. Extreme, you can see that purple line is up about 80. I don't think the semis have been that overbought. In fact, we took that line out recently. So this is the most overbought they've been in many years, maybe even going back to the dot-com bubble. I don't know. I haven't gone back that far, but you can see the negative divergence, and that's played out so far. And I also talked about the midpoint of the channel, and typically said when you get below that midpoint, is that line then acts as resistance. So at the very least, we haven't visited the bottom of this channel. Once you break that midpoint line, there's no certainties. You can see a few whipsaws here, but usually once you break it, you come down and you visit the bottom of the channel. And it's been a long time since we visited the bottom of the channel. You can see the breakdown here, back test of the midpoint channel, and then we hit the bottom of the channel. So that's my target. As you guys know, I've been honing in on the 60-minute chart here. We had this bearish rising wedge defined by these two lines, broke down. Textbook selling. Look at this. Hit that first target. I had that line there at 170.42, bounced up, came back, hit this resistance level, fell back down. We hit that trend line on Friday. We got a reaction. As I often say, the initial tag of support, for the first time in a while, that is, when I say initial, I mean once you haven't visited that line, you have to have a support line that has to be defined by other reactions. So this is when I refer to the initial tag. I mean, it's the first hit in a long time. You get a reaction. We got a reaction, but now we broke it. And the fact that we didn't bounce much more. Usually, when in the early stages of a trend, you hit that line and you're off to the races. You didn't even visit it again. You had a nice rally, came back, touched it once, boom, touch it again, boom. Now, the fact that we hit it, had a very muted reaction, and then boom, right down through it, tells me that the money is quickly leaving this sector. The momentum players, people booking profits, whatever you want to call it. The fact they didn't step in and buy it more aggressively there, and that's probably actually the midpoint of the channel. If I think about it now, I didn't look at it that way, but this is just a 60-minute chart. And this is, again, I pointed out this bear flag last week and said that's the bear flag measured target. There's also some price support there. So looks to me like we're going down a little bit more on the semis here. Trend indicators are deeply into bearish territory right now. You know what I was going to, I had intended to get to the energy stocks, XES, look at West Texas Intermediate Crude, biotechs, but there's just not enough time. So we'll wrap it up here. leave this as just a market update on the broad markets, mainly QQQ. I didn't even get to SPY or IWM, but again, they've been doing well. They're at new highs, while QQQ is not. That's what's standing out to me right now. But we're watching again, maybe healthy sign of sector rotation, maybe not. We'll see. But when you look at the semis, you can see like this one is a poster child for this recent rally in the semis. These GPU makers like NVIDIA um, has has just been the run has been nothing short of phenomenal. And then, of course, the GPU makers as graphic processing units, video cards, they were benefiting a lot from the rally in Bitcoin because they make those cards that people use to mine the cryptocurrencies. Sooner or later, from what I can read now, they're not even. I've read an article recently that most of it's being mined now in China. It's come down to energy costs because the energy is so much cheaper, electricity in China than it is here and elsewhere in the world. And they're also being done on much bigger, more powerful machines now. So I don't know how much benefit NVIDIA is going to have going forward. But either way, who knows? That you can debate that all day long. What I do know is I've been following this bearish rising wedge for a long time. Beautiful bearish rising wedge pattern, very powerful divergences building for months now, and an impulsive breakdown. It's technical analysis 101. If you looked at a textbook and you read about a bearish rising wedge, this fits the bill. And then you see a breakdown, and it didn't just limp through. We broke down one day, and then boom, an impulsive sell, very impulsive selling. Came down, hit the first support level. I have here 191.83. We bounced off that level almost perfectly. Again, these aren't arbitrary lines. They're looked, I've studied these charts. I look where the support and resistance is. You can see we hit it, bounced for 1, 2, held above it 3 days. Today was the third day after the tag, third trading session that is, and boom, now we've moved below it. That's a very muted reaction. So now that we're below support, unless we can regain that level on a daily closing basis, odds are we come down here to this next support level about 174, and then I must have put this up as an unofficial trade. I don't think it was official. Either way, those are price targets right there. T2, T3. Actually, at this point, it would be the first target, I should say. All right, we'll wrap it up here, and then I'll do separate video or static charts on the energy sector, crude oil, biotechs, and anything else that stands out. This has been Randy Finney with Right Side of the Chart. Hope you